The Bank of England has just made a big move. It has cut interest rates to 4%. This is the lowest level we've seen in the past 2 years, and it's a decision that will affect everything from your mortgage and credit cards to savings and the overall cost of living. But why did the bank make this cut now? What does it mean for everyday people? And where could things go from here? In this video, we'll break it all down for you in simple terms. Let's start with the basics. The Bank of England has announced that it's lowering its main interest rate from 4.25% to 4%. That might sound like a small change, but in the world of finance and economics, even 0.25% can send big waves through the economy. This is the first interest rate cut from the bank in over 2 years. In fact, for a while, interest rates had been going up, and fast. That's because the bank was trying to fight rising prices, also known as inflation. To understand why this matters, let's take a quick look at what's been happening in the UK over the last couple of years. After the pandemic, prices started going up fast: energy bills, food, rent, and just about everything else. In response, the Bank of England raised interest rates multiple times. Higher interest rates make borrowing more expensive, which can slow down spending and help bring prices back under control. And it worked, at least to some extent. Inflation has been falling. According to the most recent figures, it's now close to the bank's official target of around 2%. So with inflation coming down, the bank is starting to ease off the brakes, and that's why we're seeing the first rate cut now. Now, let's talk about what this means for people like you and me. If you have a mortgage, especially a variable rate mortgage, this could be good news. Your monthly payments might go down, which can offer some relief if you've been feeling squeezed by higher living costs. If you're looking to borrow money for a car, a home, or a personal loan, the interest rates might start to drop slightly in the coming months. On the other hand, if you're a saver, this might not be great news. When interest rates go down, the amount of money you earn from savings accounts and fixed-term deposits often goes down too. It's a bit of a balancing act. What helps borrowers may not help savers, and vice versa. But overall, a rate cut is usually seen as a sign that the bank wants to support the economy, to keep money moving, to encourage spending and investment, and to stop a slowdown or recession from setting in. So why exactly is the bank making this move now? A big part of it is confidence that inflation is under control. As we said earlier, inflation has been falling, and some economists even say it's dropping faster than expected. Another reason is that economic growth in the UK has been weak. Businesses are struggling. Retail sales have been flat. And consumer confidence, how optimistic people feel about the future, has been shaky. By cutting rates, the bank is trying to give the economy a gentle push. Lower borrowing costs can encourage people to spend, companies to invest, and hopefully, help the economy pick up speed again. Many experts have welcomed the rate cut, calling it a sensible move in light of falling inflation and weak growth. But not everyone agrees. Some worry that cutting rates too soon could send the wrong message, that the bank is moving too fast before inflation is fully under control. If prices suddenly spike again, the bank might have to raise rates again, which can cause confusion and uncertainty. Others point out that while inflation is falling overall, not all households are feeling the relief. Food prices, rents, and other essentials are still high for many families. So the impact of this rate cut will vary from person to person. So, what happens now? Most analysts believe this is just the beginning of a series of small rate cuts. If inflation continues to fall and the economy remains weak, the bank may lower rates even further in the months ahead. However, if there's any sign of inflation picking up again, or if global events shake the economy, the bank could pause or even reverse course. It's a careful balancing act, and the bank will be watching the data closely before making its next move. In simple terms, the Bank of England has made its first move to loosen the grip after 2 years of tightening. For some people, this means lower bills and cheaper loans. For others, it might mean lower returns on savings. But for the country as a whole, it's a signal that the fight against inflation may be nearing its end, and that attention is now shifting toward boosting the economy again. Whether you're a homeowner, a renter, a business owner, or just trying to make your paycheck stretch further, changes like this matter, and we'll keep following them closely. If you found this video helpful, don't forget to like, share, and subscribe. We post updates like this regularly, helping you stay informed without all the complicated jargon. Thanks for watching, and see you in the next video. Subscribe for more clear and unbiased financial updates every week.